ChargePoint reported fiscal 2023 fourth quarter earnings, and the stock price decreased as a result of the figures that were announced. In this video, I'm going to review ChargePoint's latest earnings results, and at the end of the video, I'm going to answer the question if ChargePoint stock is a buy. So let's start with the earnings review, and then at the end, I'll answer the question if ChargePoint stock is a buy or not. Revenue increased to 152.8 million in Q4. That was almost double the 79.3 million in the same quarter the prior year. Of course, ChargePoint is ramping up production of its charging units as EVs become more popular. The company is gaining significant market share in the US, trying to do the same in Europe, but it's not expecting to do as well in Europe as it's going to do in the US. That might be a good thing for now because the US recently passed an infrastructure bill that's going to put billions of dollars into the electric charging grid or the EV industry overall, trying to encourage consumers to adopt EVs. Now, this revenue of 152.8 million for Q4 was below the midpoint of management's guidance. Management had said they were expecting revenue between 160 and 170 million in Q4. So at a midpoint of 165 million, they came below even the bottom end of their guidance at 152.8 million. That could largely explain why the stock price was down so much after these earnings were announced. The net loss worsened to 78 million compared to a loss of 60 million in the same quarter the prior year. It's encouraging that the loss was as a percentage of revenue was shrinking. However, it is a little discouraging to see the loss continue to get worse despite revenue growing so rapidly. Cash flow from operations in the trailing 12 months that ended on January 31st worsened to negative 267 million. This was worse than the 157 million that it reported at the same time in the prior year. Another disappointing metric from these earnings results was that gross profit margin stayed flat year over year at 22%. Typically, what I like to see is, especially with companies that are ramping up and just getting underway and growing rapidly, I want to see improvements in their margins. I want to see as they grow, as their production grows, I want to see their profit margins expanding, right? And I didn't see that with gross profit margin. It stayed flat year over year at 22%. Um, of course, supply chain challenges are a big reason for that. The cost of goods sold are rising, transportation costs are rising, and competition overall is rising as everyone is trying to jump in on this opportunity of rising EV adoption, right? It's not just the charging companies, it's EV companies, it's everyone along that supply chain network trying to capitalize on this trend. The government is pouring in billions of dollars trying to encourage this evolution, and people are jumping in to capitalize on that. And that's creating some disruptions in the way things are done. That's creating soaring prices of these cost of goods that go into chargers, that go into EVs, and it's making it more expensive to roll out these products. Thankfully, the company does have 395 million in cash and equivalents, so it looks like at this rate it's got at least another year before it's going to need to raise more capital, which I suspect it's going to need to do if it's going to continue to ramp up production as quickly as it aims to and continues at these types of profit margins. The company's forecasting Q1 revenue of 127 million at the midpoint, which would represent an increase of 56%, a significant deceleration from the previous quarter's revenue growth of nearly 100%. And of course, supply chain challenges persisting can explain a large part of that. Still, Longer term, management is forecasting 2.1 billion in revenue in fiscal year 2025. That's a huge jump from where they were in fiscal year 2023, and it remains to be seen whether or not they will hit this target, whether or not they will achieve this target. If you just look at the evidence of this quarter, management gave you a target of between 160 to 170 million, and they brought you revenue of 152.8 million. So it's not like this company has a history, a long history, or a streak of giving you guidance and delivering above the guidance or at the guidance that they give you, right? So it's speculative whether or not they will reach this level, but anything even close to 2.1 billion would be a big boost from where they are now. The big question will be, can they ramp up to this level effectively and efficiently without losing a ton of money on the bottom line, having to go to investors and say, hey, give us more money in order so that we can meet this soaring consumer demand. Can they get to this level of consumer demand or meet this level of revenue with the existing cash that they have on their balance sheet? That's a big question mark as well, and a big risk, especially with the rising cost of goods sold. I don't know if they're going to be able to do that. Right, so to answer the question, is ChargePoint stock a buy right now? I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. I'm going to say no. The stock is still too expensive. It's still too speculative. There are still too many question marks to answer before I would be willing to pay a premium valuation for this stock that's obviously got excellent prospects for growth. However, I don't know if it also has excellent prospects for profitability or when that profitability will manifest. And so while yes, it's in an extremely fast growing industry and itself it's going to grow rapidly, I don't know if that revenue growth is going to translate into profit growth. I don't know that yet, and I'm not convinced of the path yet. I haven't seen enough evidence of the progress in order to feel confident that, okay, in 4 quarters it's going to be here, and then in 4 quarters it'll be here, and then after that it'll be here. I haven't seen evidence that allows me to confidently see the path the company is making, the progress the company is making towards profitability. So for me, that's a sticking point, and I won't invest and I won't recommend. However, I know others. For other investors, just the fact that they're growing so rapidly and they're in such a growth industry, that's going to be enough for them, and that's okay, right? There's those types of investors that just want to invest in these innovative stocks, and they're willing to pay these really high prices to be in these innovative stocks. That's not my style. I don't mind. I do appreciate innovative stocks, but along with the innovation, I like to see good business process, good improvement on profitability, on execution, on improvement in cash flow. I want to see those business processes as well as the innovation in whatever product or service category the company is in. All right, so that's all I've got for this video. As always, I truly appreciate your viewership. I know there's a lot of things you could be doing, but you're watching this video. Thank you for doing that. And if you like this video, I'm going to link to 2 other videos that I think you will like. So please click on one of those, and I'll see you over there.